Good afternoon, everyone. Thank you for joining us for this IMF press briefing. We are here today to present our annual economic assessment for the euro area. By now, you should have all received the concluding statement via the IMF's press center. That concluding statement has just been presented to the Eurogroup. I'm pleased to have with us today the Managing Director of the IMF, Kristalina Georgieva, and Alfred Kammer, the head of the IMF's European Department. We will start with some opening remarks by Managing Director Georgieva, and then we take your questions. Managing Director, over.
Thank you very much. We just had a very good discussion with the Eurogroup, and I can say one of the most engaged we have had, and rightly so. It is a very important time for Europe in the context of a more turbulent world. Before I get to the key messages for the Eurozone, let me give you a bit of a global context. Since our latest forecast in April, there has been some easing of trade tensions, but trade policy uncertainty remains very high. In the incoming data from the first half of the year, we see confirmation that trade policy uncertainty, together with geopolitical tensions, are slowing economic activity globally and in the euro area. So in this complex environment, what is our assessment? In a nutshell, the EU and, of course, the Eurozone need to move forward with coherent, effective policies to lift up potential growth and enhance resilience. And it is also important to ensure that new public spending priorities are met without risking that sustainability. Yes, inflation has come down to target, but there remains the need to safeguard price and financial stability at this exceptionally uncertain time, and no need to say more given what has been happening over the last week in the Middle East. What we are telling the policymakers, they know. So we are holding a mirror, they're looking into the mirror. They know that there is no room to delay because the largest trading partners of Europe are moving very rapidly. They're resetting the terms of global integration. And if Europe does not forge ahead with decisive EU-level actions, it turns to a risky place of declining relative to other advanced and major emerging market economies. So what can be done to not allow this to happen? The main discussion we had, and we actually will continue later, is on deepening the integration of the EU single market, finishing the job that you started. We saw in the Draghi and Letta reports that Europe's production structure is dominated by small firms that fail to scale up and innovate less than counterparts on the other side of the ocean. Why is this a problem? Because if dynamic firms don't grow to scale, this holds back productivity growth. And if barriers and constraints in the single market are eased to help that firms can scale up, that would unleash innovation and dynamism in Europe and boost growth. Where is growth today? We project 0.8% for this year, 1.2% for next year, way insufficient for Europe to guarantee that being a lifestyle superpower can be sustained over time. When we look at the priorities, I would emphasize 4. Number 1, reducing regulatory fragmentation, possibly through a 28 corporate regime that establishes uniform regulations and legal rules critical for the formation, operation and dissolution of firms to increase predictability okay, I got the whole word, of doing business across borders, as well as to provide legal certainty to firms when they are in financial distress. Number 2, advancing the capital market and banking unions to better channel savings into productive investments, including risky ventures, more of which is needed for productivity growth in the EU than we currently have. Just to give you one number, today 300 billion euros are invested in the United States because of the dynamism and depth of the capital markets there. And at the same time, there is interest, genuine interest in high-quality European assets. Should Europe be able to attract this through the capital markets union? Number 3, improving labor mobility via mutual recognition of qualifications. Number 4, deepening energy market integration to ensure stable, affordable energy. So just to sum it up, 1, regulatory consistency across Europe. 2, depth of capital markets that allow more investment into equity rather than through bank lending. 3, ability of people to work across Europe freely. 4, energy market integration. So what would that bring? We estimate these actions could raise the EU's potential GDP by around 3% over 10 years. It's a sizable gain. We see the digital euro with an important role to play. It can help improve cross-border payment system efficiency, reduce transaction costs, complement the ability of the capital and banking union to work, and broadly complement the efforts on the single market. On resources, we believe that EU public resources in the current and in the next EU budget must be deployed most effectively to contribute to needed investments in shared priority areas in defence, research and energy security. In our estimates, a doubling of EU budget expenditures on EU public goods from 0.4% of EU gross national income to at least 0.9% would help close critical investment gaps, to address shared challenges cost effectively by avoiding duplication of national efforts. And we also support overall increase of the size of the next EU budget to allow for investments in cost-effective manner, and do so on a performance-linked disbursements to encourage national reforms. The next point I would make is very important. why we think that cost savings from more efficient EU-level spending is critical. Because that would also help to ease fiscal trade-offs at the national levels, as many EU countries, especially those with high debt and limited fiscal space, face a difficult task of implementing significant fiscal adjustments while also managing rising spending pressures from aging populations, from climate goals, from energy security and defense. Let me make a small point on ECB policy rate. We think it is appropriate, as it neither stimulates nor restrains the economy, paving the way for inflation to stay around target. But we also recognize uncertainty is high. Depending on whether incoming information materially affects the inflation outlook, the policy path may need to be adjusted. Finally, on external policies, the EU is a major trader, and it would benefit from a world economy that is integrated with rules-based global trading system, and therefore the EU should continue to advocate for diversifying global partnerships, advancing new free trade arrangements to strengthen supply chain resilience, capture efficiency for trade, and just keep the world functioning for the benefit of everybody. So, where we are, the EU is doing well. The EU can do better. And there is absolutely no time to waste to move towards achieving the full potential of European integration. Great opportunity for Europe. Seize it.
Thank you very much, Managing Director. Now we're happy to take your questions. Do please introduce yourself, share the name of your outlet, and if it's possible, limit yourself to one question so we can take as many questions as possible in the time we have available. The lady with the scarf in the middle, please.
Hello, thank you. I have one for each. I hope that's okay. Managing Director, thanks for this. I wonder, would you agree with the assertion that the euro is having somewhat of a global moment, as put by ECB President Lagarde, and what would it take for Europe and the Eurozone to structurally strengthen the role of the euro internationally? And Mr. Kammer, I wonder if you could tell us more about the fund's evaluation of Ukraine stability going forward. So from 2026, would they require additional revenue-raising measures domestically, or are the commitments currently on the table sufficient for you to disburse? Thanks.
I'm sorry. Yes, I agree with President Lagarde that there is a great opportunity for the euro to play a bigger role globally. When you look at the search for quality, safe assets, at this point, it is facing a constraint on the offering of these assets. It is not by chance that so much is now being parked in gold. What would it take? All the things I talked about. A dynamic, integrated European economy where the opportunities to invest in equity, where the opportunities to invest in innovative firms is more present. And with the European Union moving towards higher level of spending in defense, towards integrating its energy system that provides material opportunity for euro-based assets to grow. I mean, I can tell you that whenever I go, there is a strong investor interest there in Europe. This is a rule-based economic area. And what is that constraints investors? One, regulatory fragmentation. Two, the fact that there is no deep capital market yet in Europe. Three, other aspects of incomplete internal market, like movement of skills and people. Four, energy is expensive because the energy market is not fully integrated. So these are obstacles Europe can remove. And now Europe knows exactly what they are from its own work and also from the work we are offering.
So on Ukraine, what we have been seeing and continue to see is an exemplary implementation by the authorities of the fund-supported program. And as you know, we have reached staff-level agreement on the 8th review recently, and we'll put that forward for board consideration before the end of June. And as part of our ongoing dialogue, with every time we go to the board and have a review discussion, we are looking at the financing needs of Ukraine. And we also did this this time, and we have assessed the financing gap overall of 150 billion, and that includes the whole fund program, which is for a 4-year time horizon. And this financing gap is closed with measures including massive funding by the international community. And as we go forward with every review, we will assess whether this financing gap is going to increase and will require further financing on the external side, but also whether it requires, and that is very important, additional domestic revenues. And on this one, the Ukrainians have participated in the financing by increasing revenues over time. And this is something we will ask Ukraine to continue on the revenue side, on domestic resource mobilization, because this is also important for the medium-term outlook to move Ukraine to a modern state and to help finance the reconstructions.
Next question. Any more questions, colleagues?
I think we're done.
If not, thank you very much for joining us today, Managing Director.
I'm working here to rescue my reputation and say clearly predictability. The word I struggled with. And I want to use it to say this. We are in a very unpredictable world. For Europe to be successful, it does have to build strength in its growth potential, and it does have to finish what it has started successfully years ago. The best achievement of the 20th century is Europe's convergence engine. But it has been stalling over the last years, and this has to change.
Colleagues, thank you very much for joining us. For any additional info, please don't hesitate to reach out to us on media@imf.org. And I wish you a good rest of the day. Thank you very much.